Pramod Gubbi as well joins in on the show right now. Pramod, hi, afternoon. Amidst all the chatter about high valuations, what is it that you're making of the market right now? Put money, fresh money to work at these levels? Yes or no?
Well, the overall market obviously seems on the higher side in terms of valuations, particularly given the sort of earnings that we're getting. But markets are markets. There are always pockets available to deploy capital. There are pockets which are available at reasonable valuations, or if they're fairly valued, there is enough predictability in terms of earnings growth. So that's what a discerning investor should do. But we have to work with the constraints that the market has provided with us.
Pramod, curious to know what is it that you're making of some of the private banking names and the kind of earnings that have come out so far, right? While ICICI Bank may have been impressive, there's no consistency throughout the space, especially from the big ones. As an investor, how would you approach private banks now?
I think the private banks are still one of the few pockets of value that I was talking about. Yes, there are issues in terms of margins. Deposits are coming at higher costs. To that extent, margins are under pressure. Incrementally, as we proceed through the economic cycle, you will see asset quality deteriorate as well. So both of these will put pressure on earnings growth, but nothing that the market is already not factoring in, given where valuations are. To that extent, if you juxtapose those expectations alongside current valuations, I think they're not that disappointing. Yes, there are different levels of performance across different banks, but at the same time, there are different levels of valuations and expectations of the market. So I would reckon private sector banks still remain one of those few pockets of value that I was talking about.
So point taken, that's the view coming in as far as the private banking names are concerned. But today, of course, it's the PSU banking pack, which is fairly active. And there's a bit of a comeback which has been made by some of the other PSUs as well, your Real Vikas Nigam and Mazgaon Dock of the world as well. But wanted to get a sense from you, Pramod, what's the view on autos right now? I know you guys have stayed away from autos, but is it time that you're looking at it incrementally positively, or at least in the supply chain somewhere?
Yeah, no, it's not like we've stayed away from autos. We do have some exposure both at the OEM level as well as the ancillary level. No, I think we are in a reasonable stage of the economic cycle as far as demand is concerned. And also, given the commodity prices are easing, margin pressures and earnings growth are also on a decent footing. But like I said, market as a whole hasn't left much value on the table. Which is why you need to be a little more discerning in terms of looking at businesses where there is predictability of earnings, both in terms of demand drivers as well as margin expansion drivers. I mean, it's very hard to see a cheap automobile stock, but even if it's fairly valued, you need to give yourself the comfort that the earnings growth is as a high confidence interval in terms of panning out over the next 2 to 3 years. But yeah, I mean, it's not like we have stayed away from autos. We have a very close eye on many of the auto companies.
Right. Pramod, in terms of a trigger for the market, do you think it all boils down to earnings, or there are any other triggers or cues that you're looking out for the market to move whichever way?
Well, we are bottom-up investors. To that extent, we stayed glued to earnings potentials, changes at the economy level, which could change the growth trajectory for some of the sectors and companies of our interest. However, triggers for the market could come from anywhere, right? So it is a global situation now that foreign institutional investors are coming back. They can become influential in the market, and to that extent, we are exposed to what happens globally as well, including potential rate cuts in the US, geopolitical tensions we've all been talking about for a while now. But at the fundamental level, I think now that the budget is out of the way, you have some sense of political stability and direction coming back. It comes down to earnings, and earnings is something that somebody like us focused on bottom-up fundamentals would reckon are triggers for individual stocks and sectors as well.
let me get you in as well on the conversation, because we've seen a bit of a cool off in the market after just getting close to that 25,000 mark for the Nifty. What's that really telling you? I mean, is it just a matter of time, or do you see that level as a big hurdle?
No, it's not a big hurdle. Maybe today's date is not the best date for 25,000 mark, auspicious date. Yeah. So I think we can just make away with that. But I think it's a phenomenal market, and even after the last week week volatility for the indices, where we were at one point on the verge of breaking below the 24,000 mark, and from there the markets have made a very strong comeback. So I think it's a matter of time that we break past about this 25,000 mark. The only thing which has changed positively for the markets this time around is not just the market breadth improving, many sectors participating, underperforming sector stocks making a comeback, but this time around the global markets have also managed to show some good bounce back, especially after Friday's move. So I would believe that if we see maybe another couple of days of follow through up move from the global markets, we should be easily comfortably cruising past about the 25k mark.
Yeah, we're waiting for that 25k mark. But just Pramod, last word before we let you go. What's the view on chemicals now? Because a lot of these companies have started showing, signs of bounce back, but that's been the case for the last couple of quarters as well. Would you want to make a fresh bet within the chemicals agro basket at all?
Yeah, again, I don't think you can paint everything with the same brush here, because some of these sectors or chemicals are exposed to global supply chain. In which case China becomes a big factor, given we've seen the impact on prices of several commodity chemicals after zero COVID policy was lifted in China and Chinese chemical industry entering the global supply chain. To some extent, there were signs over the last couple of quarters that sort of dumping pressure has eased, but it remains the key variable here, because the local Chinese economy isn't doing well as much as we understand. To that extent, scope for further dumping or pricing pressure on some of these chemicals will be the biggest variable to watch out for. Having said that, there's always pockets within specialty chemicals where there are defensible companies whose products are differentiated, or at least they're cost competitive. To that extent, there are moats to be protected on earnings. Plus, we have the structural driver. There are clearly global buyers who are looking to diversify their sourcing, looking at some of the Indian chemical companies and an alternative sourcing avenue for them. To that extent, structurally, I think there are companies and subsectors which are very strongly positioned. But the bigger variable for the sector as a whole remains the pricing pressure coming from Chinese companies.
Pramod, good to have you on the show. We'll let you go on that note. Let's just